It's the Thanksgiving edition of the fastest 4 minutes in finance. Thanks for checking us out. I'm Scott Inman. Lots to be thankful for around the Gen Wealth offices this holiday. We have a great team, great clients, and most of all, a great purpose, helping people discover, protect, and share true financial independence. Each week, we write and produce this segment with those things in mind. It leads us to provide up-to-date information about the market and economy, but balance it with perspective for what it means to you. Many times, that creates a goal of sifting through the noise that we know you're hearing to provide some clarity. And this week, let's challenge the noise out there that says you shouldn't be in the stock market right now because things are just so uncertain in the economy. You should wait for a better time to invest in stocks. Well, we've addressed the pitfalls of trying to time the market many times, but we were gifted a fresh take on this when the market surged last week. The S&P 500 index climbed 1.9% on Tuesday, November 14th, following the release of October inflation data that was a little better than expected. Now, this led investors to believe, or further solidify their belief, that the Federal Reserve would stop raising interest rates. Would it surprise you to know that November 14th is tied for the third best trading day of 2023? The index rose 2.3% on January 6th after a weak jobs report, 2% on April 27th after Facebook reported better than expected earnings, and 1.9% on January 20th, November 2nd, and now November 14th. In fact, the S&P 500 index is up about 18% year to date, and nearly all of that return can be attributed to just 9 trading days. That's according to DataTrek. On balance, there have been almost as many trading days in the red as there have been in the black. Again, according to DataTrek, as of November 8th, there had been 11 more positive trading days versus negative trading days, 113 up versus 102 down. Of course, even if you are trying to time the market, you may not be trying to do it daily, so let's stretch this out over a long period of time. We take a look at a hypothetical growth of a $1,000 investment in the S&P 500 from 1970 to 2019. If you remained invested through all the highs and lows over that 50-year period, your $1,000 would be $138,908. If you missed just the single best trading day over that period, your investment is worth $124,491. If you missed just the 5 best days, you've got $90,171. Missed the best 15 days, your account is worth only $52,246. And if you were not invested for the best 25 days over 50 years, you have more than $100,000 less than if you invested the whole time. The bottom line is waiting for a better time to invest could seriously impact your long-term returns or even your short-term returns. It's not about timing the market, but time in the market. We are thankful for you watching this week's Fastest 4 Minutes in Finance and hope you have a wonderful Thanksgiving weekend.